Testing, testing. Total number, maximum is 500.
Okay, good morning everyone. Okay, let's start today's webinar. Hope you had a good weekend. Exciting week coming up. Okay. Okay, for today's macro trading calls, we have 4 conviction trades here. The first one is to long China. You can do so by trading this ETF, 83188.HK. Long commodities. Here's the proxy. The GSG is the GSCI ETF to proxy this trade. We've been underweight since October of last year on shorting of gold. Recently, gold has had a 19% rebound, but we maintain a longer term short position on gold, as we will talk about this later. You can do so by calling the SBL to short this counter here. Finally, we want to short the 10-year US Treasuries. Now, we have been underweight since January this year, and we maintain this call, especially so. Okay, so let's get started. So why long China? Okay, why long China? Many people have been trying to long China for years, but I think this time will be different. Okay, first of all, if you look at the top left, China transport industrial production by volume changes, right, has had a multi-year, or rather a bottoming process, and has been improving here. As you can see, there's a double bottom from last year to this year, and there's finally an uptick. The 12-month moving average, as you can see here, has finally changed direction as well, and this looks very encouraging. Okay, China industrial profit. You also note that the reported profits of industrial companies in China has also had a change of their rate, and it's also going on an uptick. Okay, China CPI inflation is manageable, it's holding steady, so it's not going too high such that it will trigger some sort of rate hike. And more importantly, if you look at quantitatively, if you look at this is actually the PE cycles of the China market, price to earnings ratio. And as you can see, the lime green color is the 12 4 quarters trailing PE. And where we are right now is that we are actually at valuations at low as or equal as low as 09 and 06. So we are presently at the bottom of this cycle. So these 4 evidences seem to suggest that we are at a big bottoming process for the China stock market. Now, when we look at the actual chart itself, this is the CSI 300. We will also notice that for the first time in years, we actually have a consolidated double bottom. So you have a consolidation here in July of last year, and another consolidation here. And now we're at this point where we look as though we are breaking out. So this is worth looking at. It's a potential double bottom. It is encouraging that the price has actually penetrated through this 10-week MA. Okay, and we are of the bias that it will break through the 40-week and go on to continue to at least these levels. A reasonable price objective for this year is probably 27.50. Okay, now if you look closely at this chart, the CSI 300, you notice a few things. So one, we call this like an ascending triangle pattern, and we've essentially showed signs of breaking out for this. This triangle pattern is more noteworthy in a sense that because this level here is also corroborated by this long-term support line, resistance line. So this price, even though it looks small, it's actually a breakout from this whole resistance line, which is quite significant. So this is a good hint or signal that this could be a true double bottom. Secondly, the MACD on the weekly has actually crossed as well. So this also implies an intermediate cycle up. Okay, so if price can stay above this support line, okay, for another week, that will probably imply higher upside and a good reasonable target is between 2,500 and 2,600 for the short term at least, to the end of the year, I'll say. Of course, if price reverses and breaks through this resistance line, support line, we'll have to reevaluate our position. But as of now, we are long China. Okay, taking a look at the intermarket relationship. So of course we have treasuries on top here, US treasuries, 10 years. This is the Dow Jones World Index, okay, proxy of the world stocks. And here is your GSCI, or proxy to industrial commodities. Okay, now you'll notice that essentially for the last 5 to 6 years, bonds, as we know, has been on a bull market, but only recently, great weakness, a great surge down, catalyzed by Fed tapering, the news of Fed tapering. Concurrently, we have commodities which have, in our opinion, we've said it for a few weeks now, that this downtrend to us is more of a consolidation before another move up. And sure enough, there has been a starting of a breakout occurring. So if you look more closely into the charts, we'll see the same pattern. You'll see that the 10-year treasuries have indeed started to break down this very long-term uptrend line. Similarly, commodities, as measured by the GSCI, has also broken out of its very long-term downtrend line. You see over here. Okay, so we know that bonds have started to turn down, stocks are still on the uprise, and commodities are breaking out. So this kind of corroborates the story that we are around here between phase 4 and phase 5 of the business cycle. We are closer to stage 4 and stage 5. Okay, so in this stage, the strategy is simple. You short bonds, you want to long stocks, especially in the materials and energy sector, and you want to long industrial commodities. That's what you do. And stocks are still not, probably has not topped out yet. Okay. Okay, so long commodities, what does the economic data say? Actually, global growth is picking up. As you can see, the top left, Eurozone manufacturing PMIs for service and manufacturing are both ticked up, and they're both finally above 50, okay, which is positive. US manufacturing and services PMIs, they've been above 50 for quite some time now. US is doing well. Yeah, that's why the stock market of the US is leading. And recently, there's also been an uptick as well. So not only are they above 50, but there's also an uptick in their manufacturing and service PMIs. Japan is also encouraging with a strong uptick as well recently. So in totality, overall, if you look at the global PMIs, this is the JP Morgan global composite PMI, which is the lighter green line, which you can't quite see. But essentially, yes, it corroborates the story, and we are on an uptick as well, and we are staying above 50. So that is showing that growth globally is encouraging. Now, that being said, that's why we also expect commodities to break out as the economy does better. Let's get a closer look at this. So, okay, so let's go back here. So we did note earlier on that the GSCI index was breaking out from a long-term trend line. Okay, but technically, more interestingly enough, if you look at the GSCI index fund, right? You'll see that on that breakout, it was actually accompanied by very heavy volume. So this gives us even a bigger hint at the breakout of commodities, that there is conviction in the move. So we definitely think that you should long commodities, along the GSCI. Okay, here's the ETF. Okay, treasuries. Well, the strengthening of the US economy would cause portfolio to cycle further out of bonds into stocks. All right, so we know this is happening this year. Okay. So anyway, the prospect of the end of QE does two things. So the largest buyer is the Fed, and they're going to buy less and eventually stop. Okay, by Q4 14. All right, but this also signals that the US economy is strong enough to withstand QE tapering. Hence, stock remains more attractive than bonds. So these two reasons should imply that money will come out of bonds into stocks or other assets. But as the short-dated end of the curve is anchored by the Fed funds rate, the long end will be sold. Hence, short 10-year treasuries. You can short the 10-year treasuries to the TVT ETF. So in this chart here, the green color is the spread between the 10 and 2-year yield. So as you can see, the spread is at present 5%. Now, historically, the maximum yield for the last decade has been around less than 6%, as you can see here. That's the historical maximum yield. Okay. Now, this is the 2-year yield, and it's pegged down here because of the Fed's funds rate. So the 10-year is the one that can move through market forces. So what we are saying is that due to Fed tapering news and due to the business cycle, we believe that the spread will probably hit its maximum. So if the spread hits its maximum, that gives the 10-year room to move up by at least 1% yield. So what does that mean? Essentially, it means this. Okay, this is just a chart of the TNX. It's a 10-year Treasury note. This is actually 3%. It's just called 30, but it's actually 3%. Essentially, based on the maximum historical spreads between the long and short. Okay, and this is the spread between the 10-year and the 3-month. This is the spread between the 10-year and the 2-year. So it depends which one you're using as a proxy to short-term rates. But essentially, what we're saying is that if you're using the 10 and 2-year, then the maximum spread is about 3%, and here it's about 3.8%. Using these two as upper limits, right? We'll note that the 10-year Treasury yield can probably move into this region here. When you're in this region, this would be our potential price target if you're shorting bonds. So what you would do is you would buy the TBT, which is a double short ETF on the 20-year Treasury. And when this Treasury note yield reaches this region here, that would be a price objective for you to exit your trade. At least for the short term, for the 2 years. Now note, in 2 years' time, if the Fed does change their Fed funds rate, you can expect the 10-year Treasury yield to even go past this level as well. So this is actually quite a long trade, worth considering. So that's for Treasuries. What about gold? Okay, so we maintain our bearish stance on gold on a longer term. We do note that the US economy is picking up. Forward-looking core business investment is robust. The employment situation is on a very steady trend despite some below expectations print recently. The trade deficit is narrowing, and that's significantly also due to shale energy, which is a game changer. Government budget deficit narrowing as the sequester works its way through the budget. So these are all positive things to get bullish on the US dollar. And if you're bullish on the US dollar, then you have to be bearish gold. So as you can see on the top left, we can see that US new orders has been picking up. All right, for the past for this year actually, it's been encouraging. It's been upticking for the last 6 months. New orders, that's good for manufacturing. Bottom left, we see the US trade deficits actually getting lower. This will instill more confidence in the US dollar. US farm payrolls, they have been holding steady. Okay, so jobs have been holding steady at this level over here. That's also good. And yeah, and the US government budget is also decreasing as well. Okay. So based on all these factors, right, that's not good news fundamentally for gold. So as you can see, as the US dollar index has been increasing, I mean, this puts pressure on gold prices. Has been going down, as you can see here. If you look at it in a technical level, a technical basis, this is the gold spot price chart. You can see, yes, so we know that there's been a big downtrend since October of last year, followed by your 19% retracement. Okay, so what do we think? Okay, on the short term, it's possible for the price to continue going further up. Okay, although we note, and this is because we have a cross on the MACD here. On the weekly MACD, it has crossed. So when I see a cross on the MACD, it tells me it's a cycle up. The only question is whether it's a short-term cycle or long-term cycle. We believe it's short-term because of all the fundamental reasons that are against gold at this moment. So since we heavily suspect this is a short-term cycle, where can you take your short positions? Well, let's lay out a few key technical levels. First of all, this blue region here is a very heavy resistance level for gold. So if gold does retrace back to this level, this would be an excellent time to initiate a short position or to take all your profit from gold. Okay. Subsequently, you could use momentum as a gauge. This is the money flow index. It's basically a money weighted index similar to the RSI. In indices like these, right, in a bear market, right, typically the upper limit for a bear market is 70. It is not 80. 80 is only the upper limit, overbought limit if you're on a bull market. So if you're in a bear market, which you suspect we're in, this chart should not reach past 70. So when you hit 70 here, or when you hit this blue zone here, this would be a good region or signal, a good position to take your short position or to sell. Okay, another reason why that this move here, we believe it's not that big a conviction move is also because of this relative strength chart over here. At the bottom, we have the gold miners versus GLD chart. This is the relative strength performance of price between the gold miners and the gold price. Now, what's interesting is that you can really get a heads up as to what's the beginning of a bull market and what is not by looking at this chart. For example, you can see in 08 of October, you had a very big surge here, right? Yeah, this 20% plus move over here. But what's interesting is that in this move, gold price moved up. But based on this relative strength chart, gold miners had moved up in price much more than gold itself. See, this shows you a great conviction and confidence in the direction of gold prices. When the gold miners that are more sensitive actually goes up more. As you can see in this big surge up, right, the gold miners' relative strength didn't change at all. So this is just one reason why we don't think there's that much conviction in this move here, and that if it goes up much further, it should reverse. So get ready your short positions or get ready to sell. Of course, if you don't care about trading, then, well, just know that the gold price, we believe, is going down. Okay, and that's it for the macro. So now we're going to talk about the telecom sector, and it's brought to you by Colin.
Morning, everyone. This is Colin, and I'll be covering on the Singapore telecom sector for today. For today, these are the following areas which I'll be covering. First, start with a positive outlook on the telco sector and the reason for being so, and followed by other areas which investors should note. And I'll finish off with a recommendation on the telco stocks with SingTel preferred over the other two telco. So we are having a positive outlook on the telco, and this mainly comes from growth in its mobile business, which is the primary business of the telco companies. 3 to 8% year-on-year increase was reported in the Singapore mobile revenue across the three telcos, and we can expect continued growth going forward. And this is where we based on as we are positive on data monetization. Okay, based on the latest IDA figures, 28% of postpaid mobile lines are now on the 4G, and we can expect this to increase going forward as 4G offers faster speed, which allows faster web surfing and video streaming in the mobile. So this will attract more subscribers to switch to the 4G plans. And with the increased data consumptions, as more are moving on to the 4G, we can expect more subscribers to exceed the data allowance on the mobile plans. SingTel and M1 have reported a quarter-to-quarter increase of the percentage of their tiered based customers exceeding, with SingTel reporting 13%, and M1 has reported 15% of the customers exceeding the data caps. And this will incur more data access charges for the subscribers, and which will contribute to higher ARPU. We can also expect more subscribers to switch to mid-tier plans for more data going forward. So on the access data charges, SingTel will be increasing its charges from $5.35 per gigabyte to $10.70 with effect from 16 September. StarHub will be revising its charges upwards from next year onwards. Currently, M1 has the lowest excess data charge rate, but we can expect them to revise the charges soon. And on the data cap, we think there is a potential lowering of the data cap. Okay, so we note that Australia and Hong Kong has 1 gigabyte data cap on their low tier postpaid plans. So, and also that StarHub has launched a new suite of its Smart Surf HD postpaid plans, which offers unlimited voice calls, but this comes at much lower data caps compared to their conventional postpaid. So following figure shows a comparison of the 3 low-tiered plans among the 3 telcos. So all these will further drive the ARPU. So other investment merits to note for the telco sector, the telco displayed stable earnings growth and a healthy free cash flow, and they offer a dividend yields of about 4.5 to 4.8%, despite the expectations of tapering by year end, and which might lead to investors a shift of investors' preference from dividend yield stock. We think the current yields are still attractive as they offer real positive returns. As we note that MAS has revised the inflation forecast for the year to about 2 to 3%. On the broadband front, 29% of the wired broadband lines are now on fiber, and you can expect the take-ups to increase. However, the slow enterprise uptake still remains a challenge for the telco, and this actually hampers growth on its data internet revenue. For the pay TV segment, concerns still remain on the rising content costs, and this will pose a challenge, especially for SingTel Mail TV and the StarHub's cable platform. Right. So our recommendations for the telco sector is we are having an accumulate call on all 3 stocks, with SingTel preferred over M1 and StarHub. SingTel is mainly we are positive on it as it has growth potential from its overseas associates, and also it has cheaper valuations compared to the other 2 stocks. As you can see from the 3 P ratio chart, we think that there's room for the gap between SingTel P and the other 2 stocks to narrow going forward. On M1, it has higher upside potential on its mobile ARPU, and also with its new internet TV offering, Mi Box service, that might potentially create a new stable source of revenue for M1. And StarHub is having the highest dividend yield of about 4.8% among the 3. Okay. So next, on the banking sector, I'll hand over to Ken to present.
Hi everyone, this is Ken here. On the Singapore banking sector, the Singapore banking sector is actually one of our most preferred sector in Singapore at the moment, and here are some of the reasons why. First, you would note that you probably note that interest rates are expected to increase in the near term, starting off with the long-term interest rates when the Fed starts tapering or QE, followed by short-term interest rates increasing in the medium to long term. So, and the banks actually are one of the very, very few sectors that would benefit from this increase in interest rates. Second, the performance for the banks have actually been relatively positive, especially in the year to date. So our agenda for today is that we're going to talk more about why are we positive on the performance, or rather how the performance has been positive year to date, and also some of the things to watch out for in the 3rd quarter. And we'll conclude with, once again, why we are overweight on the banks and why we prefer UOB and DBS over OCBC. So on the 2nd quarter takeaway, you could see that most of the revenue categories have been positive. First up, on net interest margins, you can see on the last 2 quarters that this has been stabilizing, having declined in the last 3 years. right? And the reason for this decline is because we are seeing that although pressures remain on the interest rates that the banks are charging their customers, they are able to mitigate this pressure by with the lowering of deposit costs and also higher efficiencies through the increase in loan to deposit ratios. We also, moving forward, the banks have guided for stabilizing of net interest margins, although with some volatility in the near term. And that we're actually positive on the net interest margins moving forward because we actually see that there could be a potential for gradual increase in net interest margins in the midterm as interest rates increase. Once again, the sharper increase in net interest margins will probably come when short-term interest rates increase as compared to when long-term interest rates increase. On the loans growth, we're actually very positive. Ex-currency effects year to date, it's been strong in double-digit growth. And in fact, because of the strong performance, DBS and UOB has actually increased guidance from the high single digit to the mid double digit range for the year-on-year for FY13. And on the fees and commission, they've actually been very strong for the first half of the year. It actually has been up double digit once again year-on-year for the first half 2013. This is driven by wealth management growth and also by favorable market conditions increasing the revenue from investment banking and also from stock brokerage fees. So what are things that we should look out for in third quarter? As you guys are aware, there's been recent FX movements in quite a few of the ASEAN currencies and India. So because of the exposure of the three banks to Malaysia and Indonesia, UOB to Thailand and DBS to India, we expect that this depreciation of the FX is likely to lower loans balance. However, that said, ex-currency effects on the loans balance growth remains very strong. Also, with the FX depreciation, we would expect lower profit contributions, and the impact on the net profit due to this depreciation of the FX is estimated at low single digits for the three banks. Also, in the third quarter, we expect to see we have seen lower market activities. This is from the generally lower debt and equity activities, and also this might translate to poorer performance in the fees and commission. Also, the economic outlook for this quarter was actually weaker for the ASEAN countries, including Indonesia and Thailand. However, that said, we expect fees and commission to remain at a healthy range. The third thing that we have actually seen is this from the last quarter was that there was actually a significant increase in AFS reserve losses, right? This amount to like 500 million for the three banks in mark-to-market fair value losses. This is because the banks hold quite a proportion of their portfolio is actually in fixed income, and with the increase in long-term interest rates that we have seen, this actually led to mark-to-market losses on the available for sale securities book. Even though this actually led to a net book value, and the banks actually remain fundamentally strong, and once again, we would probably continue to see greater AFS reserve losses under other comprehensive income, but once again, the banks remain fundamentally strong. So, on our conclusion on why we prefer, our topic actually is DBS. We actually prefer DBS. That's our topic over, and then next UOB. And also OCBC, we actually have a neutral rating on it. So why DBS? First, in line with our call to long China, DBS actually has the highest exposure to Greater China and Hong Kong. And this actually, with the increased better economic improvements in that region, we expect DBS to benefit from that. Second, also DBS also enjoys a very attractive price to book valuations. It's currently trading at 1.2 versus peers of 1.3 and 1.4. We expect that there could that potentially there could be even a re-rating for DBS to debt nearer to that of its peers moving forward. Also, DBS also enjoys a very the highest current account, saving accounts deposits, and therefore they're able to enjoy the lowest cost of funding as compared to its other peers. The reason why we also like UOB is because of its strong fees and commission, and also we note that once again the loan sale growth has been very positive. Net interest margins are improving, and also probably going to improve, having stabilized in the last 2 quarters, and also UOB continues to see good overseas contribution. On OCBC, the earnings growth is healthy. However, with the further increase in the long-term interest rates, we could potentially see greater losses, lesser gains in its non-participating fund for Great Eastern Holdings, and this will probably act as a drag to OCBC's net profit. Valuations for OCBC remains fair compared to peers at 1.4, and therefore we have a neutral rating on OCBC. So with that, I'd like to conclude the presentation, and I'd like to welcome any questions. Okay, to further elaborate on the Singapore banking, telcos, and macro, we actually published 3 reports today. One on the macro report, one banking sector report, and one telco sector report. So you can actually find more information on things that we discussed today from our reports. Also, after we conclude this seminar, we'll also be sending out our slides to all the participants.
Hi, this is a question on the Singapore market. This is a good time to enter the Singapore market. At this point in time, we have to note that there isn't a weekly breakout signal yet. So I would just wait a little bit longer to see whether this week will actually break out from last week's high. If so, I think it's worth a stab. However, I remain 50-50 on the Singapore market at this point in time. Next question is, if I'm bullish on the China market, as such, will the China counters listed in the SGX also benefit from the bullish tone? Or are they still not being able to gain investor confidence after the China Minzong saga? Okay, for certain, right, the China listed companies on SGX will benefit from the bullish tone. However, every company has its own company-specific risks, and you have to note that. So, you won't be able to know which is the next China Minzong lah. So that's the reason why, to be safe, you could, as you mentioned, to invest in an ETF that covers the China A shares, which is why we suggested the CSI 300 ETF, and that will diversify and protect you from individual shenanigans from fraud companies.
Hi, there's a question on any updates on Pan United. For Pan United, the analyst covering it is currently not here, but generally we are still positive on Pan United. We continue to see very good, we continue to see strong order book wins in its building and BBM, the basic building materials. The port continues to be pretty attractive, and they are going to increase its stake in the China port, so that's a positive. In terms of our view on the ASEAN market in general, we actually the view is that we are slightly more positive in Indonesia, in most of the ASEAN markets moving forward. That includes Indonesia and Malaysia. On Thailand, we will need to wait and see for more details before confirming And one of the reasons is because we see a bit of slight bearishness on the subsidies given to the rice farmers.
Okay, here's a question. Will Fed tapering have I assume, Fed tapering have any bear effect on the CSI 300? Yes, but we actually think it's going to be positive because Fed tapering only occurs if the U.S. economy is robust, and that would probably mean much more exports on China's part. So that's actually a good thing. I guess the only thing to care about for China is their own central bank, whether they will increase their rates. But because inflation in China right now is under control and is stable, we don't see that happening. So any improvement to the global economy will be positive for the CSI 300.
Hi, I'm Lucas here, covering the real estate sector. There's a question about Singapore property market and whether it has bottomed out yet. Currently, I do not think that that's the case. If you're looking at the big developers in terms of them having quite substantial residential exposure, the market is still kind of soft, and they are actually expecting quite a subdued remaining 3Q, 4Q of 2013, and I believe that most real estate service, be it their research houses, be it all the service consultants, they are all predicting that there will be a 5 to 10% correction in the residential market, in residential prices. So you can see that developers will generally delay their launches, or they are willing to stomach such discount to achieve prior sales launch rate. So no, it's not going to bottom out yet. We do not think that the price of the developers are going to see any rebound right now. We are still more bullish on we are neutral on the commercial real estate sector, and we are actually more bullish on the retail and hospitality sector of real estate. So look out for such counters that have exposure. Another question is on property versus REITs. I believe that both the counters, the developers, and the REITs have both corrected quite a fair bit. But once again, the REITs prices is underperforming. It's kind of holding back because of the impending increase in interest rates. So I think the situation is quite murky right now. There's really not much chance to actually look far into the horizon. So no, it's quite soft. We are still bearish about it. So yeah, that's all.
Some questions on the banks and the telcos. For the banks, what's the expected time frame to achieve your respective target price for UOB and DBS? This will be in the range of 6 months to a year. Given the FX exposure, there may be some slight near-term softness in the third quarter results. However, long-term wise, the banks continue to be preferred, and we expect the banks to continue to outperform the STI. Once again, this is due to them being able to benefit from rising interest rates, and also that we see very good growth in the revenue categories, including the fees and commission, the loans, and also the net interest income. On SingTel, how is Optus Australia's outlook to SingTel? On Optus Australia, they are actually in the process of refocusing and actually we have actually seen quite a bit of success in the sense that EBITDA margins have actually stabilized, even though revenue has actually decreased, which is similar to that of the other players in Australia. On Optus Australia, I think the biggest near-term downside is actually in the AUD currency. The Australian dollar is actually down, and actually that has caused the decrease in the Aussie dollar, the depreciation has actually caused SingTel to revise downwards on its FY14 guidance. Another question related to this would be the India. Where's it? Where's the India one? This one. Oh, on the India economic situation and currency impact on SingTel's bottom line. On India, SingTel has a exposure to India through Bharati. The Indian currency is down approximately 10-11% quarter to date. So that would have a bit of an impact on SingTel through Bharati. However, I think once again that the main downside from this FX depreciation is actually coming from Australia with the depreciation of the AUD. So once again, India's economic situation and currency has a slightly lesser impact compared to that of the Australian dollar.
Hi, the question I have, this is Ken Ko doing the market strategist one. So the question is the TBT ETF discussed short ETF or bond tracking ETF? The TBT is actually a double short leveraged ETF. So if the 10-year treasury price goes down by 1%, on the short term, the TBT is supposed to go up by 2%. So buying the TBT and going long on the TBT is actually playing the short side of the treasury price itself. What is your outlook on the US bond ahead? Well, as we mentioned in the chart already, we are actually bearish on US bonds. In fact, it's highly possible that we are in a multi-year bear market for bonds. Don't forget that the US bond market has been going up for the past 6 years, and it has come down. It has come down some time, and now with and if you look at our business cycle, we showed you all the signs. We showed you the sequence of asset classes changing. That heavily implies that we are in stage 4. So if we are in stage 4 to stage 5 of the business cycle, it means that we have potentially started on the cyclical bear market for bonds or multi-year bear market. So we are definitely bearish long-term on bonds.
Okay. There's a question on whether the QE tapering and the increase in interest rate will affect the telcos. On this, basically with the QE tapering and with the rise in yields, this will have an impact on the shift of investors' preference away from dividend yield stocks. So there is some impact on this, but however, we are still having a positive outlook on the telcos, mainly of its growth elements, especially for SingTel, where we still have a growth potential in its overseas associates. And the telcos, whether they are highly leveraged and with high capex requirements, on this aspect, the telcos would say it is manageable, and in fact, their net debt to EBITDA margins are steadily declining. For the capex requirements, for the 4G rollout has already been achieved nationwide. So now we can expect some higher requirements, especially in 2015 and 2017, where they are required to make payments on the 4G spectrum that have been allocated in the recent 4G auction bid.
Hi, there's one question regarding the commodity outlook. We are bullish on the industrial commodities. However, for agri, we are still neutral, given the fact that there is still, given the fact that the second half we will still expect to see higher production as compared to the first half of this year. As we will keep an update on the commodities sector and keep you guys informed if there's any interesting news coming up.
Hi, question on Malaysia market. Just to clarify, so sorry about the small error. We are actually more of neutral weight on Malaysian markets. However, we are not bearish on the Malaysian market. We even though right now there's the concerns over current accounts and fund outflows, but we see that the Malaysian market should be able to withstand all this.
Hi, here's a question. Question on how will Syria issue affect gold? Gold can be used as a fear asset at times, but ultimately it's an alternative asset that is seen as a alternative to fiat money or the US dollar. So essentially, on the short term, I suppose Syria may cause volatility in gold prices, but ultimately on the longer term, the strengthening US dollar will probably override all these short-term effects. Hence, we are still long-term bearish on gold.
Okay, for counters under the commodity space, Singapore listed companies under the commodity space, we are still bullish on Wilmar. We don't cover Nova, so we can't comment on that. Why Wilmar? Because under the low commodity price environment, Wilmar being a supply chain manager will still be able to benefit from the low commodity price. As for pure upstream players like Golden Agri and Indofood China, you guys will probably have to be more wary when investing into these counties, because the stock price movement will be more correlated to the commodity price itself. Do note that Golden Agri has 95% exposure to more than 95% of the net profit is exposed to the commodity CPO palm oil prices. So yes, do take note. So all in all, we are still bullish on the supply chain managers for the commodity space. Thank you.
Hey guys, hey, I just want to do this is Ken Ko here, the technical analyst here. I just want to do a quick poll for you guys. Off late, I've been getting some suggestions that I do a webinar that will maybe explain more effective technical analysis, or explain some of the indicators that I use in better, more effective detail. So right now it's still in planning phase. So I just want to ask everyone whether you guys would actually be interested. And if I get enough responses, we might actually do that a month from now. So if you're actually interested, could you just type in yes right now so I can see it? So once again, okay, all right. Okay, there are a lot of yeses. Okay, okay, so I suppose we'll be on that, and we'll try to plan something for you in the coming months. Okay, thanks. Let me get back to answering the rest of the questions. Okay, thanks for the feedback, guys.
Thanks everyone for attending the webinar, and we will see you next week.
Sorry, and on the last note, you guys, I believe, have been asking for where this webinar is. You'll be sending out the slides to you guys after the webinar. So do watch out for it. And yep, sorry for the hiccup previously. Yep, that's all. Thank you. Thank you very much.